And welcome to another Leumi Financial Corner. With us once again, Michael Zaremski, head of U.S. Private Banking, Bank Leumi USA, member investment committee for Leumi Investment Services. Michael, good to have you back. Thank you for joining us.
Great to be back, Zev. Thank you very much.
I was opening the paper, the New York Post this morning. I said, Michael. It said the headline is, in big, bold letters, the incredible shrinking dollar, inflation up 5.4%, worse than 13 years, milk, gas, wine, eggs, all cost more. I don't know if you saw the headline.
When I looked at the Post today, I saw the same piece, but it said repeat, and it was Pete Alonso winning the home run derby for the All-Star game, so I was very happy about that.
Okay.
But as for the second part of it, it's been a very interesting conundrum, and I think that the market that we're seeing right now, there's a very clear distinction between how you looking at it from the fixed income side, or if you're looking at it from the equity side. And I think that reflects some of the comments that you allude to with inflation and the New York Post headline. First, let me say that the views that I will be sharing today are mine, not necessarily that of the bank or the broker-dealer. But again, I think that the prism that you're looking at is going to really alter the view that you have. And we've just recently had some of our internal investment committee meetings, and we've really seen a dichotomy between, what is the bond market telling us, what is the equity market telling us, and there seems to be a big disconnect between the two. So while, again, the Post is putting out a lot of factual information about higher prices, the bond market's not really reflecting inflation fears right now. In fact, since the last time we spoke, bond yields are actually, meaningfully lower, and they've actually broken down from the prior levels of about 150 to 175 on the 10-year. Right now, that's kind of sitting between 130 and 140. If there truly were inflation fears as kind of designated by the bond market, we should expect to see bond yields rising. We've also seen the 30-year yields come down pretty meaningfully as well. So again, there's some weird dynamics happening, and I think from my perspective, a lot of that just has to do with how much intervention there is from the Fed and how that's creating distortions in the market. And we've talked about this before, but while you do see some prices rising, the Fed continues to stand by the comment that a lot of this is transitory. And again, we've talked about lumber before, which is now down well over 60% from its peak. Lumber is now down to levels that we haven't seen at lumber in over a year. Copper is down meaningfully off of its peak, more than 10% or so. And even though the headline articulates a shrinking dollar, on the global currency markets, the dollar actually remains strong. So again, when you look at the equity markets are reflecting a different story, and the S&P 500 has actually made all-time highs 10 of the last 13 days. So the equity markets continue to move forward. GDP continues to be strong. Earnings are robust. And again, you're probably seeing more signs of a growing economy and inflationary aspects on the equity side than the bond side. So very difficult to kind of assess where we go from here. And as you noted, the CPI, which is kind of the measure of consumer prices, up month over month, up over year over year to levels that we haven't seen in over a decade. So it's really difficult to make a determination of kind of which way the wind is blowing, with all these different cross currents that we have. And I think what I go back to is there's kind of a battle right now between what is the Fed calendar and what is the market calendar. What does the market believe? What does the Fed believe? And which one is going to be the dominant factor? At this point in time, what I kind of continue to go back to is there's three major drivers of what's happening in the world, or at least the U.S. economy. One of it remains COVID, so we're seeing some of the concerns over the new variants coming on. But again, while there's a lot of headline concerns of it, it still doesn't seem like we're anywhere near back to pandemic levels, and the new variants don't seem to be, at least on the surface, as dangerous as the original, particularly with a very highly vaccinated population. Fiscal policy has kind of ground to a halt a little bit. Gridlock has limited the impact of major policy decisions. So again, the worst of tax policy, the worst of spending policy, the worst of anything that we might think about is kind of off the table because of the gridlock. So to me, the main driver continues to be central bank policy. What I would also point to, Zev, is people seem to forget that the Fed does have a dual mandate. The dual mandate is price stability, which is kind of inflation, and the other part of it is employment. And while people are focusing very much on the inflation element of it, again, as you so rightly noted from the Post headline today, recent comments from the Fed continue to point to the fact that unemployment levels are still low. Employment levels are still low and still worse than pre-pandemic. So when we look at the Fed calendar, the Fed has pretty much told us that they're not expecting to see a normalization in the employment picture or the employment data until sometime after September, when more and more of the corporations will be going back to work, more school children will be going back to school, and therefore allowing people to go back to work. And they're expecting to start to see normalized data September, October. So what they're basically telling us is that regardless of what the market calendar is in terms of their expectations for things like inflation, until they get a clearer sign and a clearer picture of what the employment picture really looks like, and I would say that that's kind of the definition of what their transitory periods are, they're not really going to do much or anything except kind of give us guidance. Once we get a clearer picture later in the year, September, October, maybe even a little bit deeper as to what the employment levels are, then we'll probably get some more clarity from the Fed of what their plan is to start easing away from the extraordinary accommodation that we're still seeing every day. So that kind of leads us into some of the other conversations that we'll likely have later in the year about tapering, interest rate hikes, etc. But again, from a Fed calendar perspective, they've pretty much told us that they're on hold and not really doing anything unless something major changes until, at the earliest later in the year when they start to see some clarity on employment.
So your basic message, Michael, we've been saying for the last number of broadcasts, is that don't let the hype of the media get you, because at the end of the day, things are moving, and yes, we're going to see inflation now, but it's going to go down with more supply on the market.
It's largely a correct statement, and I think that the problem that many people have right now, and I've tried to articulate this, the economy as a patient, okay? If you're trying to measure the vital signs of the economy, and again, look at it as if you're trying to measure the vital signs of a patient, if I had you on, if I had an oxygen mask on you and you were breathing in fresh oxygen, and I put a little oxygen reader on your finger to try to measure what your oxygen level was, chances are it's going to read pretty high if you got an oxygen mask on. That does not in any way reflect what your real health condition is, because you've basically been medicated with the oxygen. And I think that that's a situation of kind of where we are right now. Because of the accommodative policies of the Fed, so many of the vital signs or vital statistics that we would usually look at to give us guidance are not really valid because they're being manipulated by all this Fed accommodation. So I've heard many clients with very legitimate arguments as to why there's inflation, why the Fed should act, etc. And my answer to them is ultimately it doesn't matter, because they are not the Fed chairman, and the Fed is the pathway of what they're going to do. And everybody else's opinion around that is a little bit irrelevant, because they're the ones defining transitory periods. They're the ones interpreting what the data means, and they're the ones that are going to make those decisions. And again, I think a lot of the focus right now on inflation, while valid, is discounting the second half of the mandate, which is full employment. And until we start to see a clearer picture on the employment data, which again, we really won't get until the unemployment benefits run out, a lot of the special COVID relief spending runs out, until schools go back, until children go back, and until everybody goes back to work, so to speak, we're not going to get a clear picture of that. So again, I think all policy is on hold for a while, and as long as policy is on hold, I think we're going to continue to see what we've been seeing, and that means the fixed income markets are going to be reflecting some of the tensions, but the equity markets remain the outlet for the fact that there's really not much else to do for people that are seeking returns. So my general comments to most people is, whatever you're comfortable with in terms of taking risks, stay the course. I think a lot of the conversations about market valuations, while there may be validity to the fact that the market may or may not be expensive, the market may or may not stay expensive for quite some time, particularly as we're facing, a significant accommodation from the Fed. So if frankly, I think the one place where you really are truly seeing inflation is financial assets, where there is a tremendous amount of money chasing too few assets, and that's basically the U.S. equity market, and that's why you're continuing to see prices rise. The flip side of that is you are also seeing very powerful earnings cycles right now, a very powerful earnings season, and in many cases you're seeing companies that are kind of growing into the PE ratios that are out there. So again, it's tough to really get clarity because there's many cross currents of wind, but ultimately I think we need to just sit tight from the Fed and continue to monitor what their direction is going to be.
Michael Zaremski, can I say you're a breath of fresh air? You injected some oxygen into this conversation, so we appreciate your being here with us. Michael is head of U.S. Private Banking, Bank Leumi USA, member investment committee for Leumi Investment Services. Look forward to speaking with you again.
Thank you very much, Zev. Always a pleasure, and look forward to speaking to you again.
And we're going to be right back.